Hello, is this coming through? I think it is. Great. Well, here we are, last day of February. Glad to see all of you that could make it. We are really honored to have a special speaker with us today, Tom Potiowsky, a well-respected economist that's presently working with Portland State University as the chair of their economics program, and it also has been an advisor to the governor of the state of Oregon on 2 different occasions. So we really have a very informative, but also a very entertaining presentation for you today. I think if you look through the flyer invitation that was sent out for the forum, you'll see that we're going to talk about a lot of different topics that are on everybody's mind these days. PERS, TPP, employment, housing, jobs, whether they're part-time, full-time, pay. So Tom's going to hit a lot of these subjects. I had the pleasure and the honor to go ahead and hear him at the Clackamas County Business Alliance Board meeting a few weeks ago, where he kind of touched on a lot of these subjects. We didn't have as much time. Today, he said that he would be willing to go ahead and focus more on our local community. So I think you're going to get a very personalized presentation, and then we'll have time for questions and answers afterwards. But before we get started with the presentation, I want to make some announcements. First of all, I'd like to thank Combee Bank for being the sponsor for this event. It didn't come cheap, but it's worth every penny, as you will see. And the Senior Vice President, Regional Manager, Ken Junt's going to be saying a few words here in a moment. I'd like to recognize the Chairman of the Clackamas County Commissioners, Jim Bernard. And we have County Commissioner Paul Savas. Appreciate you coming. We also have our Mayor, Dan Holliday. And Mayor Brian Shaw. No. Or excuse me, Commissioner. Oh, getting ahead of myself there. Sorry, Dad. That's the last time I'll do that, I hope. Excuse me.
And we want to recognize Tualatin Mayor Lou Ogden.
Oh, great. Sorry, Lou, I didn't see you over there.
We also have our newest commissioner, Sonia Fisher.
Oh, Sonia, you came in there as well. Everybody's coming in here towards the end. We also have City Commissioner Nancy Ide with us. Make sure I don't miss anybody. I know we have former Mayor Alice Norris with us. We thank you for that. Oh, and yeah, that's right. And former Commissioner Carol Pauley is here as well. And former Mayor Dan Fowler. Why doesn't everybody stand up? Room full of VIPs, that's for sure. Okay. Well, I'm sure we're all glad today's the last day of February. Tomorrow's the first day of March. I hope I don't see snow again until next December. We've had one winter, but it looks like it's sunny out right now, so green and color and flowers ahead. But with that being said, I'd like to turn it over to Ken to go ahead and say a few words about Combee Bank. Thank you.
Great. Thank you, Kent. Appreciate the opportunity to be here. Let me begin by saying I so much appreciate and value the work that the Business Alliance does here in the local community, and the focus and the drive towards economic vitality for all of us. So let's give them a round of applause as well. Combee Bank is really just a regional community bank that's focused on 2 primary things. One is building the relationships with our clients, and 2 is supporting the communities in which we serve. We've got folks involved with board memberships. I know that Sherry's is on the board here for the Alliance, and that's throughout the entire community that we really strive to have that relationship. And I think that's one of the pieces. If you think about those 2 things, building the relationships with our customer base, as well as being supportive and really active in our communities, in my view, that's a really strong force for us, having a really strong presence in each of the markets that we serve. You may have heard recently about an acquisition that we did, Pacific Continental Bank out of Eugene, Oregon. With that acquisition, it brings our bank to the size of about $12 billion. That's with a B, $12 billion in size. So we're getting to be fairly substantial from the size standpoint. And we'll have about 150 branches serving you in the Oregon, Washington, and Idaho communities. And so we really look forward to that. The presence of Pacific Continental in the Eugene marketplaces, it takes us from a very small presence in that marketplace to the #1 market presence in that community. And it also strengthens our relationships in Portland as well as Seattle. So we really look forward to that. That acquisition should become, I think the deal is planned to close in June, and then we'll do a migration into our systems probably in the latter part of September. As I think about the team that we have here locally and their focus is really to present our bank as a premier business bank in this community. And we hope that by way of doing that, building the relationships with each of you, and I want to recognize and thank you for the support that you've given to us as a bank over the last few years in terms of our growth as well. It's been pretty phenomenal, and we certainly appreciate that support from each and every one of you that do. And those of you that don't yet, we look forward to those conversations in the future as well, looking to see if we can assist you. But their focus, in addition to building relationships, is really being that financial advisor, being that part of your management team that looks to plan for your future, for your direction, what you're trying to accomplish, and what we might be able to do to help support that. We've got a few of the members here, starting clear over here to the left. Sherry Henson. Y'all know Sherry. Ashley Jones. We have Steve Schellenberg. And Jenny Nichols. And I know you're all anxious to hear Tom, so I'm going to put the microphone down or give it back to Kent and in between your bites and let you introduce. Thank you.
Thank you. Appreciate it. Oh, and we've got another county commissioner that has arrived. I don't want to leave anybody out. Ken Hummerson. Oh, Renata Migelbird, city commissioner. Where do these people keep popping in from? All right. And if I left anybody out, raise your hand, okay? So I don't want to forget anybody. A couple other announcements that I just want to make note before we get started. On March 16th, we're going to have the State of the City address, where Mayor Holliday will be giving us an update of where we've been, where we're at, and where we're going here in Oregon City. That'll be held at 11:30 here at the Abernathy Ballroom. On March 28th, we have the State of the City's address. We no longer have the City of Damascus, so we won't have that mayor there, but we will have the Mayor of Gladstone, Mayor of Milwaukee, Mayor of Happy Valley, and Mayor Holliday will be speaking. That'll be at the Monarch, and I believe that's usually a lunchtime event as well, but we'll be sending out an invitation to all the members of the OCBA, reminding you of that. And then on March 11th, Mike Albin, where's Mike? Right here. Going to go ahead and have you kind of announce about the chamber event that night.
That's right. On behalf of the chamber, and Mr. Halliday asked me to do this, we invite you to the annual banquet, March the 11th, 5:30, for the Chamber of Commerce. It'll be at the Tumwater Room. I invite you to come and join, check the website, and sign up.
Okay, great. Thank you. And then just one final thing. We do have comment cards on every one of the tables. So just as we do at all our other forums, we like to receive your feedback and input as to what you like about the presentations, areas that you'd like to see us improve, topics that you'd like to see included in our future forums. And I'll be announcing at the end of today's presentation our subjects for the month of March, and we already have planned for April, and are talking with people for the summer months as well. So getting a lot of interest from other people that would actually want to come and be a part of events each month. Also, on your way out, if you're interested in becoming a member of the Oregon City Business Alliance, and we've surpassed 50 now as our membership, so really excited about that. We have application forms at the outside table that you can fill out, and a little bit of background information as to why we were formed and what our mission is. So with that being said, the good doctor here, Dr. Potiowsky, Tom, is going to go ahead and share with you some very exciting information. I know it'll be something we'll really get a lot out of. So with no further ado, Dr. Pitrowski.
All right. All right, can you hear me fine? Yeah. Good. You know, the last time I was introduced as Dr. Potiowsky, it was a small group, and one of the people in the group asked me, hey, what line of medicine are you in? Without thinking, I said, hey, I'm not that kind of doctor that helps people. I'm an economist. The sad part is how they shook their heads that they understood that was the case. Well, it's a pleasure talking with you. There's a number of people that have seen quite a bit of this presentation already. I don't believe they're slow learners, and that's why they're here. But, you know, I'm very glad that they're here again. And hopefully you'll get some more information than we had last couple times I've been here. Usually I don't come to Oregon City, and this is the third time this month I've been talking in Oregon City. And one last statement I want to make before we get off the ground here and get going, and I need to get my clicker here. I'm just coming off the board of the Federal Home Loan Bank of Des Moines. I was an independent director there. And previous to that, I was an independent director with the Federal Home Loan Bank of Seattle, but now they merged, and now they cover Hawaii, Alaska, all the way through the Northwest, Wyoming, Utah, North Dakota, South Dakota, Missouri, Iowa. But what I've learned in that group is, I didn't really have much of a connection with community banks before, but I really found what an important role they play in our financial system. And how important it is to a lot of communities where, without their presence, I think there'd be much less economic development and housing and so on going on without the community banks. So I'm very appreciative, and I'm great that Columbia Bank is sponsoring this today. Hey, that was to wake you up. All right, we're going to go and I'm going to drill down first. We're going to start at the high level. We're going to talk a little bit about the U.S. economy because, really what happens in the U.S. economy and internationally affects us even right there down in Oregon City, right? There isn't an Oregon City mortgage rate that's different than any other mortgage rate, right? These are conditions that affect all of us. So this is a little ad right now for the Northwest Economic Research Center. I was state economist, as was mentioned, and went back to Portland State really to start this center and really have this is my baby, and it's great, all the projects we're doing. And I'll say a little bit more about that in a moment. But we're really easy to remember. NERC, we're just one letter away from nerd. We do a lot of mathematical, statistical type work. All right, so let's go into the U.S. economy. This is gross domestic product, our broadest measure of economic activity. And what we've been seeing now recently is that expansions over time have become longer, but the expansions themselves tend to be a little slower growth. So longer expansion, but the growth's been a little bit slower. And so I have a little contention with our president of trying to say, well, you got to get the U.S. economy growing faster. We've got to do it. Look how slow it's been. Well, when you haven't had as high a population growth as you had in the past, when you start to have an economy that transitions more from a manufacturing base to a service base, you tend to get slower growth. So it's not a situation, I don't think, of some past administration, whether it be Democrat or Republican. Since World War II, we're kind of getting a situation where we're this sort of more developed type of economy, and it tends to grow a little slower. So I'm going to come back to that as a theme as we go on. You can see these recessions in the 2001 recession. That lasted 8 months. The Great Recession lasted 18 months. And that's the longest recession we've had since the Great Depression. And that one lasted 43 months. And it really came to an end in March of 1993. And I really think the reason why it came to an end is because that's the same period that we got rid of Prohibition. We started moving, and da-da-dum. That was you'll get the timing. You'll get up. All right. So, anyways, 2000. Last couple of years were not bad. These are quarterly growth rates, mostly under 4%. Mostly into the 1% to 2% range. And historically, that is a bit slow. But as I said, I think we've moved into a period of time where that's more the norm. And the 3 to 4% is going to be the unusual periods. Summary of 2016, consumer spending. Consumer spending is about 3/4 of economic activity, and it didn't do too bad this 2016. The interesting part, I think, of what we've seen in the U.S. economy, and this actually does drill down to even our communities here, is that in the holiday season, if you were a web-based internet seller, you did pretty good. If you were brick and mortar, not so hot. And you want to start thinking about that technology and how that's changing retail. What does that mean for downtown retail areas and so on that are going to have a little bit more of a headwind going forward, facing sort of the technology that we now see across the internet and the wide acceptance now, basically, of you feel okay to buy by sitting down at your computer. Technology is changing so rapidly. We're going to have taxi cab drivers are going to go the way of elevator operators, right? It's going to be an obsolete function anymore. So those are the thoughts in the background you want to keep in mind, technology and how that's changing our economy around. Business investment was a little slow in 2016. It picked up at the end. I'm going to show you a little bit that also in Oregon, we had kind of a slowing down in terms of our manufacturing sector. So we'll have to take a look, see how that goes forward. Housing has picked up quite a bit. As you know, international trade was down a bit. Part of that is kind of a double whammy, and it's the same reasons that sort of affected our manufacturing sector here too in Oregon, is that we had the U.S. exchange rate. The dollar was a stronger value. That makes our goods overseas look more expensive, and that's a headwind. And then some major trading partners like China. When they're going slower, that they buy less of everything. One of the things they buy less is of U.S. exports and Oregon exports. So international trade's been a little bit soft. And then government's been kind of going sideways. What I mean by that is that wasn't a statement about government. Sideways in the sense that, we see some strong spending that really followed the recession, right? The Reinvest in America type act. But 2016, we're really starting to see the federal deficit starting to decrease a little bit. Because of these great spending programs are coming to an end, and a concern about the outstanding debt getting bigger. Now, we'll come back to that theme because it seems the Trump administration believes that economic growth will solve all problems and that you can spend and spend and spend and you will grow your way out of any deficit, and taxes will be stronger because of that. I don't see it, but we'll take a look at that. This is that real private domestic investment. These are physical things. You can see that sort of trending down here, how it's gotten softer as it really boomed over here, but a little bit of a jump up here right towards the end of 2016 in the last quarter. I threw this in because we just heard about, Trump's going to have a press conference, and he's going to talk about, one of the things is federal spending on defense. And so I put this up together, and I just said, well, I wonder what does it look like over the past administrations? And we have George Bush here, basically 1989 to 1993, and you can see that the spending as a percentage change from one quarter from a year ago, he was decreasing federal spending on defense. Clinton, interestingly enough, these are all decreases, these are changes, and then there was just some increases right at the end. G.W. Bush had mostly increases throughout his term, and of course, Obama really did decrease it quite a bit, sort of coming back to sort of a landing point, no real increases. So, I wanted to see if really it was the Republicans, you get more defense spending, Democrats, you get less defense spending. Not quite a pattern there. But definitely, we've seen that defense spending really be dropped quite dramatically in this past times. And I think that we'll definitely see it go up, especially with the Republican Congress, House and Senate, and then with the president. Now, my worry about all this is not that I'm a dove and I don't want national defense. My worry is just spending and how that could get us into some trouble. So, going forward here, unemployment rate. This is the US and Oregon here. Notice right over here, it's getting pretty flat. And usually, when you come the unemployment rate down and you're getting to some historical low levels like we were just before the recession, and it's sort of flat, those are indications you're kind of hitting full employment. You know, it's harder to eke out and get more and more people employed when you pretty much have everybody that is employed has a job. Now, now that was a misnomer. And what I mean by that is when we have unemployment, it's sort of three aspects of unemployment. You have cyclical unemployment. You know, the economy tanks and people are out of jobs because businesses are bad. When the economy starts to get back, that cyclical reason for unemployment starts to go away. We also have frictional unemployment. There's generally no hardship associated with frictional unemployment. I have a job, you know, I see other people getting jobs. I think I could get a better job. I voluntarily quit my job and I'm out looking for another one. I mean, there's no hardship in that. But that sort of friction, so we always have some sort of level of churning. So we have some unemployment in the economy. Then the structural is the one where we can be sort of at full employment. The job openings and the people available for the jobs are just about all filled, but you have this other group of people that either because of technology or whatever other reasons don't have the skills available for the jobs that are open. And that's a hardship because they would like to work, but their skill set isn't matching what's out there. You know, and that's something possibly, hopefully education or skill training can help protect that. So when I talk about full employment, I don't mean that there's no suffering out there, that everybody's happy, but you're at a point where it's really tough to increase employment and get unemployment down any further. And if you have more and more economic activity, you know, you squeeze the balloon, what doesn't get popped out is more employment. What gets popped out are higher prices, higher interest rates when you start to reach full employment. All right? So, let's take another look at a broad measure of unemployment. This is for the U.S. This is what's called U5 and U6. Now, U3 is what you hear in the papers. U3 means in the last 4 weeks, were you looking for work? If you were, you're unemployed. If you weren't looking for work in the last 4 weeks, you are not unemployed. You're not in the labor force. You're not a statistic one way or the other. U5 comes in and says, hey, what about these discouraged workers? What if somebody was looking in the past, say, 6 months, but they couldn't find anything and they gave up, but if a job was available, they'd take it, right? So let's add those people in. We should count those as unemployed. And then U6 says, let's take other marginally employed people that are doing part-time that would love to have a full-time job, but all they can get is part-time. And so you add all those in, and you get these really extreme sort of unemployment rates, almost reaching 18%, where we were more towards about 10 to 11% in that other way of defining it. But all these have nicely come down, and we're coming down just about to the same levels as we had low points in previous cycles. And that's my other aspect is, you know, if we do have more economic growth, is there some group of people out there that we can bring in the labor force and have them work? Well, we brought all these marginal people, right, that were discouraged workers and so on, are all starting to come back in. So we're starting to reach that constraint that it's going to be tough to get any more workers into the jobs. We're going to get, and maybe many of you in the businesses here are already starting to see some tighter labor markets out there. This is the average duration of unemployment. This is one of the bad signs of our Great Recession. You can see that historically this is still way up there. People have been unemployed on average now for over 30 weeks. And this is a real chronic problem. These people are basically leaving the labor force, and this number probably will go down because of that, rather than they're actually getting jobs. It's tough to psychologically get an employer to take a look at someone and say, you've been unemployed for a year and a half, what's wrong with you? You know, you get that stigma. And so these people, as I said, we'll see this come down. It has at least come down quite a bit from its historic highs, but this is how we really got hammered in this recession, because it's the worst really since the Great Depression. But we're coming in the right area. Now here, you can barely see it at the very end. See how that labor force participation rate? It's starting to go up a little bit. And that's that aspect where the cyclical parts are gone, but people have been unemployed, the economy is pretty strong, and people have re-entered the labor force. And when they re-enter, I wasn't looking for a job before, but boy, you know, I see Joe down the street, he's got a job and so on. I'm gonna start looking. Now that I start looking, I'm part of the labor force, and if I don't have a job at that moment, I am unemployed. That keeps that unemployment rate from going down further, right? More and more people entering the labor force. But once again, I think our ability to squeeze more people, that's getting constrained too. All right, some other financial aspects. Interest rates have come down. We were at the bottom, of course, bottom fishing here for quite a while. We're getting a little bit of tick up. Interest rates are headed up. Even though you can read in the paper, we've got this strange thing going on with the stock market, right? Stock prices have gone up and bond prices going up at the same time. That's not supposed to happen, you know? So something odd is out there in the financial markets going on. But the fundamentals are there, believe me. In my mind, we may see these short-term little changes and aberrations, but rates are headed up. Let's take a look at the Consumer Price Index. The core CPI takes out energy and food prices, those volatile items. And that's why this dropped really dramatically in the recession, because energy prices fell so much, and the orange line did not fall as much. But you can see we're bouncing around here, sort of the 2% range right now. The interesting thing I found about this, I was just thinking about this graph, and people that are in business now and so on, and you take a look back and you go, well, you know, there's people, we have a generation out there that doesn't really know inflation. You know, there's some people that didn't have to live through the 70s and the very early, 1980, 81 with high inflation. They don't know what that means to have inflation. So I think that's going to be interesting about behavior out there. And I think it's possible, given that, you can have people caught off guard when prices start to rise. And I threw this one in. People hardly hear about this inflation measure with the Personal Consumption Expenditure Price Index, mouthful. And I put in the 2% line here because that's kind of the demarcation that the Federal Reserve uses when it tries to decide whether to raise interest rates or not. So it's taking a look here at 2%, and you can see right at the end, we've been bouncing around the same kind of idea, core and the usual one, right about 2%. Now, in my mind, the Federal Reserve is taking a look. It sees the unemployment rate pretty low. It sees the Consumer Price Index, that last one, by the way, has bounced up above 3% in the last monthly measure on an annualized basis. This is starting to push up to their limit. I think we'll definitely see at least 3 rises of interest rates in this year from the Federal Reserve. There'll still be the baby steps, the 25 basis points each time, but I think at least 3. Just because the economy is pretty strong, and as I'll point out, if we do get any of the tax cuts at the federal level, the public expenditure expenditures going up, national defense expenditures going up, you're goosing the economy while it's at full employment, and you're likely going to see even more prices going up and the Federal Reserve reaction to pushing the interest rates up. It's not bad news, okay, really. Well, here. Let's talk about the Oregon economy. The outlook, by the way, for the U.S. is that 2017 going to be pretty much like 2016. Could possibly be a little stronger, depending on the timing that certain federal expenditures or tax cuts happen in 2017. But for the most part, there isn't any particular bubble out there, right? You know, expansions do not die of old age. They die because something went wrong. There's a bubble, speculation, something out there that throws things off. And so right now, there doesn't quite see anything out there. I'm going to return to housing prices in a little bit, because some of you may feel that there's a bubble happening there. Or also, people feel that there may be a financial bubble in the stock market. All right, this is a big map of the U.S. This comes from the Federal Reserve Bank of Philadelphia. This is a coincident index. And the thing to see here is that green is good, red is bad, all right? And so North Dakota is bad. Definitely because of the energy prices, rig counts are down. And I really don't know why anybody would want to live in North Dakota anyways. Yeah? So it's really tough, you know, if you're living there and you don't have a job. You got 2 strikes against you. You know, and consequently, we'll look at some migration patterns. They're moving to Oregon, right, where it's green. All right, this is Nonfarm Employment. The amazing thing, I sit on the Oregon Governor's Council of Economic Advisors, and we were always wondering, you know, could we ever see another sort of 90s or even the short burst that was in the early 2000s again? Could employment ever get to that high? And sure enough, and for an extended period, we are up there at the highest that we've seen recently, you know, in history. So that's pretty strong growth. Now, can it continue? I'm going to give you an outlook in a little bit, and I'm going to argue that we can still have positive growth, but it's going to be tough to maintain this high level of growth. And it is related to those other aspects I've talked to you about in terms of population growth, the labor force participation that's out there. It's just going to be tougher to push a lot more jobs out there quickly than we did in the past. Here's the unemployment rate for the 3 areas, and you can see how it's that flattening out again for Oregon and the Portland MSA. Portland MSA is the metropolitan statistical area, 5 counties in Oregon, 2 counties in Washington. And you can see some pretty low unemployment rates, especially for the Portland MSA, down to 4.3%. Oregon hardly ever has an unemployment rate less than the U.S. This has only happened a handful of times since World War II, and only on a month basis, never on a yearly basis. And part of it's just our economy. You know, we've got this rural, urban kind of mix, natural resource economy and so on, and it tends to just keep that unemployment rate somewhat elevated. So this is really indication of pretty strong growth when we can get below the U.S. rate. Here's the Oregon labor force participation rate, and my colleagues back in the Office of Economic Analysis, Josh Lehner, put this together. What he did is he said, well, you know, we know demographics are causing labor force participation rates to go down, right? As you get an older population, the percent of the population that's either looking for work or working tends to shrink relative to the total population, right? And so naturally, we should see this labor force participation go down because of demographics. And so what he did is he constructed this it's a make-believe construction based on age patterns and labor force participation in earlier time. And then the age groups have changed. We've got older people now. And then what's actually happened. And you definitely get these drops because of recessions happening. But look at this big jump back up, right? This is people re-entering the labor force. And it's also because of in-migration patterns. We've also boosted up people that are moving into Oregon, and especially the Portland MSA area. So do any of you have a 20-year-old, young 30-year-old still living in the basement? Tell them to move. Tell them it's time. They don't have to live down there anymore. There's jobs out there. People are getting them. All right. Now here's just some population increases by the 7 counties that make up the Portland MSA. Clackamas is expected to have a pretty good jump up in 2015 to 2030. We'll maybe say a little bit more about that when we zero in on Clackamas. Clark is always the quiet sleeper out there. You don't hear that much about Clark, but it really is, it's in terms of at least population growth, the 3rd strongest among all the counties. Multnomah expected to bounce up, and then especially Washington, because it's easier to move out in Washington County. Multnomah County, you got to move up if you're going to get more people here. In Skamania, we expect the same thing to happen in the next 15 years. It happened in the first 15 years. We expect 1 family to move in. All right, and then these are the patterns, as you can see. I just picked out the top 4 here, and all are doing quite, depending on your view, all are doing quite well with population coming into the counties. The interesting part here, just as a side note, migration patterns are influenced by business cycles. You had the dot-com collapse, right? The high-tech problem at the early 2000s. And the 2 counties that had the slowest in-migration growth is Multnomah and Washington at that time. So what happens economically does influence population trends. All right, let's take a quick look at an economic outlook going forward here. Sunny with a chance of showers, all right? And then I'll just have you read this next one. I actually looked up at javelin contests, and there are people that have been speared in javelin contests. All right, that's my disclaimer. All right, so what NERC is doing these days, and we're going to be rolling out a new forecast, and I hope to get an announcement out, and maybe the Business Alliance will provide this announcement to all of you. May 17th, we're going to have a breakfast meeting at Portland State in the PSU ballroom, where it's going to be a half-day meeting with breakfast. We'll roll out, and we'll have forecasts of these items for the 7-county region and the individual counties that are listed here. We're going to have 2 panels, one on population and employment, to discuss where the Portland MSA is headed. And then we're going to have a separate panel on housing. We're going to have one of the senior economists from Zillow give a presentation. She will also be on the panel. We're also having the chief economist from Windermere will be on this panel. So I think that it'll be a good half day on May 17th. All right, here's that same map. North Dakota still red. But this is not coincident. This is looking to the future. In the next 6 months, what is expected? And so the strongest growth is expected in the green states. And you can see in this map, a lot more is green than was before. So the view here is that, 2017 is going to be a pretty decent year. Not your 3.5%, 4% type growth, but definitely, getting that 2%, maybe possibly low 3% range, either just as well as 2016 or maybe even a little bit faster.
So what's with Rhode Island?
Rhode Island, greater than 4.5%. And I think that's because they were sucking air before this. They weren't doing well at all. And they got a slow bar, and it's easy to grow fast. Ever been to Rhode Island? Providence is a beautiful, beautiful town. All right, so here's an outlook. This comes from our Office of Economic Analysis down in Salem. And the view here is that, we have this strong growth for Oregon. And you can see, this is typical for Oregon, right? Bad times, we fall deeper. In the good times, we grow faster. Very typical of us. But the view here is that going forward, we're going to be slowing down here in the next 10 years. And so still the view is positive growth, but we just can't keep that level of high growth going. The population change just isn't there. The employment to come in and get jobs isn't quite there. So we'll still do well, but just the growth rate's going to be slower. This is for the Portland MSA that we're forecasting. You can see that almost 3% growth for well over 4 years in this segment, definitely over 3% in the most recent period, and then an expectation that's going to slow down as we get to the next 10 years moving forward. This is a look that we had for total non-farm. Non-farm is that's the easiest data and the most current data that they can get. It's not that they don't like farmers and get the data on them, but this is the most recent that the labor departments can get. So pretty good strong growth as we went through the second half of 2016, but we dropped in employment and manufacturing. And this is part of, I think the headwinds, a lot of it was through international trade. Because of the strong dollar. And then China tends to be either number 1 or number 2 in terms of a trading partner for Oregon, and they're slowing down. Now, some people have always asked me, well, hey, China, I don't trust their statistics at all. How is it possible that they're growing before at, 14, 15%? Well, I don't trust their statistics at all. But I have confidence that the same poor slob is keeping numbers, right? And so when the numbers go down, consistency means they've slowed. Even though they're down now to 8% growth or 7%, that still seems like awful fast, but relative to where they were, that is a slowdown for their economy. And that affects our exports going to them. Service sectors have done marginally better, but there was also a little bit slowing in the second half here, and professional business services have been relatively strong. This is an outlook. By the way, this is an index, so everything's set at 100, so it's relative to where they were just as the recession hit. And you can see construction, we lost about 30% of the jobs, pretty deep with the housing crisis and then the financial crisis on top of it. We haven't quite come back up to the same level of employment just before the recession, but it has increased quite nicely, and the construction is now spread throughout the state, not just in the metro areas. Durable manufacturing is generally one of the most cyclical parts through the economic cycle, and it's also come back pretty well. And then non-durable. One of the things that is included in there is food processing. And microbrews, for example, if you're making beer, all that is in there, and hops, I guess, make people happy. All right, so now let's drill down to Clackamas real quick. This is the breakdown of employment in Clackamas County. And you can see that health services and education has the largest piece of the pie here. And now, when they use this, they call this the national, the NAICS codes, National North American Industrial Classification System. This education is private education. It's not the local government, or it's not state education, all right? It's not public, it's private. And the big chunk of this are health services. Leisure and hospitality is next. Retail is next. And then leisure and hospitality, durable manufacturing, pretty good chunk actually, because it's within these first 5. And then about a little less than 50% are all the other industries combined. So what's happened here? One of the interesting things we find is Clackamas County is definitely a private home type of county, as opposed to Multnomah, where you'll find multifamily units surpass single family. But all the counties had this happen to them, where the split was a little higher in multifamily and less than single family. And the question here is, going forward, is this the new norm now that we've just seen? And what does that mean for land development and so on, if the demand is more in multifamily than single family, as examples? Or is it going to start to revert more back to where it was? Now, it may not seem like 4% is a big move, but it really is historically quite a big move in terms of the split. Now, if you talk to millennials, they will say, heck, I saw my parents, they had a house, it was underwater. I'm just going to rent There's Zipcar if I need to use a car. I'm going to live near a big metropolitan area. I'm going to bicycle to work, you know. I'm not going to have kids, you know, da-da-da-da-da-da-da, you know. Yeah, then they grow up, yes. Now, an old white guy talk about millenniums is not proper in my mind. What do I know, really? But I did have one guy that worked for me, really bright guy, typical millennium, rented, so on and so forth. And then, as he got into his early 30s, you know, they had their first child. Then they bought a house, right? They bought a Subaru, so they tried to stay Portland-ish, you know, somewhat, you know. But, you know, and then he also took a job that was not as good as the job he had with me, but definitely paid more. You know, so the idea here is maybe, you know, this is more temporary, and we're going to probably go back more to the traditional split between these two. But I also believe that we may not get all the way back to where we used to be. I think we're still going to see a little bit more multifamily relative to single-family split than has been historical. And then this is some of the employment aspects. Once again, this is an index for Clackamas County, and this is our forecast out 10 years. Health services and education really did pretty well, you know, through the recession. Didn't really have a bump down, and our expectation that it's still going to be growing. Part of it is by demand. There's lots of, you know, baby boomers retiring as the population ages. Their needs for health services grow, and you're going to have a bigger demand in this area. Now, at the same time, what's going to happen to the Affordable Care Act, Obamacare? These are unknowns as to how that may affect this sort of outcome. Right. And then this is housing, permits. And you can see hardly ever has we ever seen a spike of anything that occurred where multifamily in Clackamas County has been above single-family permits. But it almost seems like we're already starting to get a little bit of that split occur again. Maybe not as huge as what we saw, of course, during the buildup of the housing boom period, but a little bit sort of returning back to where that is. All right, so go to quick talk about housing, real quick, because we got other big things to talk about. This is the whole 7-county area. We've not in history, basically, have seen in the 7-county area altogether, multifamily being about the same or even greater during periods of time than single family. Now, if you look at Multnomah County, sure, you might see multifamily bigger than single family, but not a Washington County, which has, you know, definitely is a single family type of place. Clackamas single family, Clark is single family mostly. And so this is quite a change. Now, part of the change here, of course, is with the housing crisis, the financial crisis, being able to get a mortgage is much more difficult now than it was before. You know, it's horrible in my mind that, you know, today, to be able to get a single family, you know, mortgage, you have to show a source of income. I didn't ever know it would come to this. Right? But, so I think like I said, we're probably going to go back more to a single family to multifamily split, more historical, but it'll take some time before that. And so in the meantime, land changes and so on have to deal with more multifamily units coming on board. This is interesting. This also comes from the Office of Economic Analysis from Josh Lehner. He took a look and he said, hey, what's happening to some of the income brackets in the Portland MSA area? And this is an 8-year change, 2007, 2015. And he said, you know, these income brackets have actually shrunk a little bit, and we've had the biggest increases in these income brackets. Now, many things can happen here. These are new jobs, so that people have gotten new jobs at higher incomes. People that were at lower incomes they've got their education, whatever, and they've moved on to higher incomes. In-migrants coming in that had jobs of higher, but the aspect here that's interesting, that what he did is he said, if I take a look and say, what about if 30% of your income went to sort of housing, what could you afford? And he used, by the way, the lower brackets on these, like 75,000, 100,000, and then used 150,000. And said, what monthly rent could they afford if they were doing this, if they had these sort of income and 30% of their income went to housing? And so here's the rents that they could afford monthly. And then if you backed out and said, well, if this was comparable to a mortgage, property tax, insurance, right? And I worked that backwards to a mortgage rate and everything else, what sort of value of house would those monthly payments look like? And so these are the values of the houses that people could afford based on those income categories. So here's the crux. You've got prices that have been double digit now for a couple of years in the Portland MSA area going up. How can these prices keep going up? How can they be sustained? Well, you've had people coming in here that have the ability to pay those prices. And if you're talking about the millennials that have maybe, say, a software job, and they're getting paid, low six figures, and where do they want to live? They want a house that's really close to the city center. The housing prices go up tremendously. But, as I said, the interesting part here is they can do this. So this is different, because this isn't because of what we might call speculative action, people flipping houses, and so we're getting a bubble happening in the housing prices. Well, there's the economic capability to push those prices up. Now, I think that we are reaching kind of a plateau, and I don't think we can see those being pushed up as quickly as they were before. Let me give you some data from Zillow. This is taking houses in prices and putting them in 3 tiers. So if the bottom third, the median price would be about $254,000. The middle group would be this, and then the top 30%, the median price is over $500,000. Interesting part here is notice that, remember how people I'd buy a house, it'd appreciate a little bit. I could move up to the next level, move up to a bigger house, a higher price house. The distances have gotten a lot bigger up here to be able to do that. So that's a little bit of a headwind for especially the upper valued homes. This are the inventories of homes. This is part of the reason why we've had the prices go up. You've got a stronger economy, you've got the demand going up, and at the same time, the supply of homes available has gone down. So price goes up pretty dramatically. But you can see there's sort of at least we're leveling out here. In the lower and in the middle tier. We've actually had a bit of a boost back up somewhat for the top tier homes. So this is another indication. I think things are starting to plateau a little bit in the housing market. This is an interesting one. We took the Zillow data and we said, well, how many listings are there that have price cuts to them? And so, we're coming out here, not very many price cuts. Prices are really going up. This is the period right here, we're sort of mid-2015, where you hear the story where I went out to get a house, and there were 12 other people along with me as the house was first being shown. Everybody put at least 15% above the asking price to be in at least the ball game of trying to get the house. But notice, that's also turned the corner a little bit. This is still pretty low in terms of, price cuts, but the trend here, and especially in the upper division ones, have gone up. Another indication, I think, that, hey, things may be plateauing a little bit in the housing market. That ability to keep raising those prices are getting a little bit tougher. Of course, this may just be really greedy people, too, that posted it really high, and they said, well, I got to take a cut. All right, and then new households. This is just another diagram. I'm going to go past this. Oh, and then this is the Case-Shiller index, one of the most broadly used indexes for prices. And you can see even that's shown some drop here. A little bit of a kick up just at the end of 2016, but still, coming down just a little bit. Another indication I think things are plateauing a bit. No crash in the housing market, just that pressure, that ability for prices to go up double digit is going to be tougher going forward. All right, headwinds and tailwinds, a big long list here. China economic growth, we talked a little bit about, geopolitical risks, and then the new administration, fiscal and monetary policies. You know, what's going to happen with infrastructure spending, tax cuts, Dodd-Frank. You know, community banks right now are very worried about this because it looks like the low-hanging fruit is to get rid of the Dodd-Frank regulations that affect really large institutions. So you take those away, you leave on the regulations on the community banks, that puts them at another disadvantage in dealing, you know, in the financial markets. So we'll have to see what happens in healthcare. And I could have added here immigration. You know, you talk to people out at Nike and Intel, they're very worried about this. You know, because a lot of their talent and so on that they bring in comes from overseas. All right, U.S. dollar exchange, we talked about. I'm going to talk a little bit about the Trans-Pacific Partnership. Energy prices, they seem to be firming a little bit, but I think they're going to stay relatively low. It's not going to be much of a problem. The last one here, I think, is can the three branches of government be of one mind? And what I mean by that is the Trump administration cannot overnight do all the things it wants to do. There's a Congress. There are fiscal hawks in Congress that are worried about too much spending, taxes being cut. What's that going to do to the size of the deficit and the outstanding debt? We have a Justice Department that already has stepped in a little bit on the immigration issue. So the ability, I think, for the Trump administration, it can nibble around the edges, right, with executive orders. But to big changes are going to have to go through Congress, going to have to go through the justice system. And so I don't see a lot of those changes that they're talking about happening this year. Maybe at the very end, but it's going to be 2018 before, if we get these things through, before we're going to see these changes. My worry about these parts right here, especially the spending and the tax cuts. I love a tax cut, just like anybody else would like to have a tax cut. Does public infrastructure need help? Yeah, I agree with that too. But it would have been great if Trump was doing this in 2009, when we were in a deep recession. No. I mean, if Trump was around in 2009, that is what the policies would be very, very helpful. But when we're already towards what I've been talking about, a full employment economy, it's tough to get any really fast, more growth with these kind of policies. You're going to tend to get higher inflation and higher interest rates, in my mind. All right, let me this is an interesting slide. It's pretty busy. I'll give you the main points. The main points here are that of the top 1% of U.S. exporters, 90% of this group are also importers. And they account for 66% of all goods imported. Likewise, the top 1% of the U.S. importers, 96% of them are also exporters, and they account for 60% of all U.S. goods exported. So how do you punish the people that import stuff and reward the people that export stuff when they're the same people? Yeah, you slap them and give them a candy bar. I worry, you know, of anything the Trump administration is doing. My biggest worry, and for Oregon, is the policies on international trade. We are dependent on it. We've gone through a long period of time in toward making trade relationships with various countries. I think we figured out that it's maybe not a good idea to do bilateral trade agreements. Regional ones cover everyone else better, so you don't have a trade embargo against somebody and they trade to Canada and Canada trades it back to us and they get around it because it's only a bilateral agreement. I think you need regional stuff. So my biggest worry of a headwind, and this would be more as we get into 2018, is what may happen on international trade. And this is international trade for goods and services. If you want to think about it too, immigration is an international trade of people. And if we cut out, a workforce that some of our corporations in Oregon are dependent on, farming is dependent on, that is an economic hit in the eye. All right, and this is real quick on the proposed TPP. By the way, the Trans-Pacific Partnership is in a sense easy to go away because Congress never signed on it and the president never signed off on it. So given that there wasn't an official law about this or an agreement, this is an easier way to get away. But the idea here and what they're pointing out here is that this would be detrimental to Oregon for its exports to have this go away. And plus, we don't know what it's going to be replaced with, which is the unknown. Real quick on cost of living, one of the headwinds, Oregon's cost of living has been going up a little bit faster than what has been in the U.S. Main reason for that has been the cost of living. Housing has really gone up in higher price. Also, what's been happening to debt? This is throughout the U.S. Mortgage debt has always been the highest percent of debt at households, but number two are student loans. And if you think about economically now, what group of people tend to own homes? College educated. What group tends to have the lowest unemployment rate as a group? The college educated. And what is one of the main tickets for rising yourself, getting yourself up, economically in life is having the college education. And if you have a financial headwind of people getting into college, you start to have more and more of the bipolarization in the economy of the haves and have-nots, which is not good. This is a little statement about millennials too, going forward. The percent of people having driver's license, 16-year-olds to 20, 24-year-olds, even 25, 29, even right through here, the proportion has dropped over time. And this is the, millennials, we already said they'll probably revert back to be more like it's sort of their baby boomer type relatives. They don't want objects, they want experience. They want to go out to eat. They want to travel. They don't want to be burdened down by payments like a car payment or a house payment. But as I said, I think will slowly change as they age. Just going to do it later on in life. The other aspect that I've take from this, because on the side you see that people 70 over, the proportion has really risen quite a bit. So young people don't want to be on the street with these geezers. Yeah. It could be just as simple as that. That's why they're not getting driver's license. All right, and then, this is an issue I think we're going to have to face somehow, because I think this is causing some of the polarization that's happening in our economy and among our populace. When we have economic growth, we want the waters to rise and all ships rise with the rising water. But here you have the top quintile, the top 20%, has gained in their percent of total income in the economy, and these other groups have either stayed flat or have gone down a little bit. So when you start to have more income inequality, there are people that start to wonder why and want results very quickly. Think about almost at the exact same time, we had the Tea Party come about and the Occupy Wall Street group come about. Two very different groups, but happening about the same time. And so, I don't want to not a downer point or something, but, this is an issue that has to, and I don't know how to address it other than we want to give people the ability to go to college. We want to have all these sort of economic opportunities for people and try to remove as many barriers to economic opportunities that we can. Finally, maybe some short-term or could be long-term risks for us closer to home. Measure 97 did not pass, but this could at least start some discussion of tax reform. Now you want to keep a broad mind here in tax reform. Tax reform has generally been code word for tax cuts, but tax reform could be tax increases. depending on how the legislators address these issues. And we may see a gross receipts tax brought up again as a possibility. One of the senators, Senator Haas from Beaverton, had a alternative to Measure 97 that was a much lower rate, but a broader base that he was proposing in order to not have 97 go through. He thought his was more reasonable. I have to agree with him. His is more reasonable if you're going to do this. So watch this carefully, because I think this will come up in the legislators. If you want to see exactly what they're looking at, take a look at the state of Ohio, their commercial activity tax, what they call CAT. You can go on to the state of the government of Ohio, and you get a good description of what that tax may look like, and they're trying to actually model it against that. So that'll give you a good sense of what that might be. Minimum wage, I think we're going to see some hits to this occur. We're going to see leisure and hospitality and retail and healthcare are some of the areas that mostly employ people with minimum wage. Some of the healthcare people are a bit worried because they're dependent on Medicaid and Medicare payments back. And the feds just say, well, here's what you get. They don't care if in Oregon you say, well, my costs have just gone up. Well, you just get the same payments. And I'm sure those of you that have already been to the airport, you maybe want to get a bite to eat. And who do you talk to? You talk to your Apple iPad, right? And you choose the food. Once the costs of labor go up, you start to have these technological substitutions occur. So so I think what we'll see is both with the minimum wage higher, which I think it should have been higher, really. I think it had been way too low, although Oregon has always been above the federal. And I think the way that Oregon did it was probably the best way if you are going to raise it, a recognition that living costs are different in different parts of the state, so that Portland will get the highest minimum wage, the other metro areas the next, and the rurals will get the lowest increase for a minimum wage. But we'll have to see how this shakes out and what that does. PERS. I have to do full public disclosure. Do not throw anything. I am a tier 1 person. Boo. I think what we may see, now, by the way, these two taken to get Medicaid coverage, Medicaid and PERS, Medicaid coverage is causing the bigger budget hole relative to PERS. Doesn't mean PERS is a problem, right? It definitely is a problem. But this is the one that is more worrisome. And I'm somewhat worrisome the way we've approached this because we knew PERS was going to be a problem. The feds already told us that they weren't going to keep doing the Medicaid coverage and they were going to back off on that. We knew this train was coming down the tracks that was going to cause a budget problem. And it's happening at one of the best economic times and one of the best growth of tax revenues in the state. Not good to have budget holes when you have the best time for revenues. So what we'll see is we'll see less coverage occur. They're going to drop people off the rolls because just can't afford to do it. PERS, the courts have pretty much allowed the legislators only to really nibble around the edges. But one of the things that can be done is there's nothing that says that you can't have a true 401k type program for public employees going forward, right? It's all the legacy aspects that are tough in the courts. So you can at least start to go forward. And believe me, and don't cheer, people like me will soon be dying off. Not soon enough. All right, very quick, I'm almost out of time. Housing policies. Homelessness, affordability is such an issue. They do the one-night count every 2 years. And so they just did this last January, and I don't know what the numbers are yet. But if we go back only, about 6 years, the homeless count has gone up 34% in 6 years. That's huge. So what can we do about that? And then affordable housing? Well, you are here in Clackamas County, Oregon City. you should watch to see what Portland is doing, because I think you're going to get the same kind of pressures and needs to do that you have here. You know, there's an excise tax, 1% on construction permits now. There's affordability housing bond, you know, raising property taxes, raising $250-some million. Inclusionary zoning. So now as you build a multifamily unit, you have to have certain of the units that are going to be below market value. And then we have in Salem then, and also Portland, talking about rent controls. Now as economists, you know, rent controls we feel are not a good way of being able to help out people in affordable housing. What happens in our minds is that as you have the rent controls over time, you'll get a small fraction of people will have affordable housing, and a larger group of people will not be able to obtain it, because one of the aspects that will happen here is that there will be less development of multifamily units. If I can't get the return to that, I'm not going to develop it. If I already have a multifamily unit and it's under rent control, maybe a parking lot's a better use, or an office building, something else, right? Some retail spot. And so I think what happens is that the rent controls will hurt the supply of affordable housing. And it's sort of, you get the reverse of what you're actually trying to do. But these are desperate times, and politicians are desperate to try to do something and show that they're doing something. All right, so you should take a look at these. And then the state transportation package. You know, I drove over here today, and, you know, does anybody work? Or are they just out there driving? I can't believe it. You know, so we'll definitely see them try to tackle this, but once again, you know, if we're trying to improve the roads, have better capacity on the roads and so on, and if we're looking for federal dollars to help us out, I'm afraid we're on the naughty list in DC, and we're not on the good list. And so it may be questionable how much actual federal dollars do come in. And I think you'll also see a revival finally of the Columbia River crossing, I-5 will come back up as a discussion. All right, I can take some questions if you have some. Yes?
I just have one when you were talking about...
The question was, we saw, you know, we had the one graph on construction. It came down quite dramatically, and now it's coming back up, but it hasn't really come back up to the level it was before the recession hit, which in the graph there would have been first quarter of 2008. And part of the reason it hasn't come up is that first, the housing bubble, the boom was so strong that construction employment, I think, was definitely not sustainable at that high level of housing activity. And so when everything crashed, it came down, we're having housing come back, and it just hasn't come back up to that level yet. So I think, you know, maybe, 8-10 years out, we will finally reach back up to the level it was before. But we're doing it in a more controlled way, rather than having all of a sudden a huge housing boom again. Housing's coming back, construction's coming back, but it's just going to take a long time for them to get back to the level they were before.
Well, we just have a huge labor shortage in the field, so that's why.
She was saying that they have a huge labor shortage in the field. Yes, I agree with that, and supply and demand does work. And what you're going to see is, and we already saw some of the in-migration numbers, people are going to start coming in if they know the jobs are here. And so there's a catch-up time that has to happen. Yeah.
You mentioned briefly about agricultural...
Well, the question here is how might farms be, and agriculture be affected by, say, the immigration policies from the Trump administration? Once again, you know, the wine growers, the crop growers, I mean, there's so many aspects of agriculture which is dependent on migrant workers coming in. If they can't have the workers, I think we're already starting to see some areas in California that are having problems, like asparagus or something I heard, where they're just letting the crop lie there because they don't have the workers to be able to pick the stuff. So it's technically not good for our agricultural sector. because they really are dependent on having those workers come in. I don't, yeah, what's the capability of, say, the Trump administration cutting off federal spending to the states that are, declaring themselves as sanctuary states? I don't think it's very good. I mean, you'd have to really get Congress completely involved in that. And I don't think there's enough in Congress. They're not willing to have their own trade wars among themselves either, I don't think. Where one's, I'm going to vote against your state getting money. And so, like Washington and Oregon congressional people will do something to them. So I don't think it's more jawboning, I think, at this point, than it's going to be in reality. Yes.
Interest rate increases. What do you think the prime rate will be 1 year from now?
Well, I usually like to make forecasts at least 15 years in advance because no one will remember what I said. I would put them anywhere from 75 basis points to 100 basis points, or one full interest rate above where they are now. Somewhere around that range. And that's pretty much across the board what you'll see on the various rates. Finally, we're seeing some of the long-term rates actually, starting to go up. See, my feeling is once financial markets really do get to see any sort of information out there that inflation is taking hold, you're going to see the market interest rates really start to pick up. And then, if they believe the Federal Reserve is saying, well, I got to really clamp down like I have done in the past history to stop inflation, then you may start to see the inverted yield curve with short-term rates above long-term rates because they expect the Fed to clamp down, and then in the longer term, inflation will be less, and that brings down those market rates. And if you see that inverted yield curve, run for the hills. That's been almost a consistent measure for recessions.
I've got a question for you, and I've got the mic. Just out of curiosity, Tom, when you were talking about workforce participation, and we also talk about the type of jobs that are being created, where we've got the lack of the skilled labor to go ahead and meet some of the job openings, are you finding that more and more people are having to take a lower paying job to go ahead and participate in the workforce?
So it depends on what industry you're coming from. If you have traditionally been in some type of manufacturing industry, and we're finding that the jobs are becoming less and less in that area, traditionally like a wood products industry, these people find themselves with the skill set that they have and background generally taking lower pay jobs. At the same time, we're getting lots of jobs coming up. The sort of poster child one is the software engineer or the STEM type jobs, right? And these people are being able to move up and taking higher pay and getting higher wages. We're carving out the middle is the problem. Those older manufacturing jobs that were, semi-skilled, well-paying, those are disappearing, and we're getting the occupations of lower pay and occupations of higher pay are the ones that tend to go up, and the middle is being shrunk.
I guess it's specific to one industry, but Intel has laid off a lot of people in the Pacific Northwest. How is this going to impact us here in the Pacific Northwest in terms of those kinds of jobs?
Well, Intel has laid off quite a few. At the same time, I think prospects for them moving completely are at least not on the near horizon. They're trying to retool a little bit about what their specialty is and what they go into. So I'm somewhat hopeful for them going forward. I'm not too worried about that. I think you're going to get these ups and downs occurring with these type of manufacturers. What we tend to get, unfortunately, especially with computer electronics over time, is that we get a kind of a stair step where, down period, there's some layoffs, and it goes up, but it doesn't quite come back up to where it was, and then it steps down a little bit. And so I think we'll probably still continue to do that, especially as technology, provides the ability of high tech to produce more with less labor. But not as a wholesale, it's over type of deal. Yes, sir.
Tom, we've probably got time for one last question. Actually, we don't have time, but I'm going to take one last question, and that's for mine. If I had to choose the most profound thing that you've said today, and it's a tough choice, thank you for the presentation, was you said, expansion does not die of old age. Something goes wrong. That was really profound to me. Expansion doesn't die of old age. You would expect expansion to keep going unless something goes wrong. How is that true also with population growth? There's a large element in this city, in this county, that feel that there should not be any more growth, that we should be stopping everything right now. And to me, that's doing something wrong. How can you stop growth if that's considered a form of expansion?
So, I was hoping to get out of here before I had a question. I got my graduate degree at University of Colorado at Boulder, and this is back in late 1970s, early 1980s. And back there, they had an urban growth boundary, and the motto of the city was, I'm here, close the doors behind me. Mentality. And we get a little bit of that here, too, happening. A little bit. A little.
Calm down, Ken.
So here's the interesting part of crux of a problem. Many cities, would like to have, like the city of the Portland City problem, where the value of homes are high, there's a vibrant restaurant, scene, all this culture stuff going on, and with higher income people and so on in here, it's no wonder that there's affordability problems, right? Because of supply and because of the people that are here and so on, and so it really is, in my mind, up to the populace, the citizens, as to what they want for their area. And there is a trade-off, in my mind. If I want to close the door behind me, I don't want more growth to occur. If Eddie does, I keep higher housing prices. Everything is higher value. People that can afford are the ones then that can live here. Your trade-off then is, if that's what you want, you're going to have a homeless problem. You're going to have, affordability problems because of what your makeup is of your area. At the same time, do you want to be Houston and Dallas? You want growth to spread out? If it does, and you can grow, you can build anywhere, you'll get house prices down. You'll have more affordability. But you give up certain other things that you like. Somewhere there's a sweet spot, but the determination of that sweet spot is up to your citizens and how you vote and who you elect.
Well, with that being said, that leaves the question still out there to be determined.
Yes.
All right. Thank you, Tom.
Ken, thank you.
Great. Really appreciate it.